Jai Gurudev, my name is Dr. Ashish Gupta. I am working as an assistant professor in Maharishi School of Business Management at Maharishi University of Information Technology. So today I will be discussing about financial management. This is my lecture number 1. So we'll have a look on the content which I will be discussing with you. So in this lecture I will be discussing about the introduction of financial management, the key aspects of financial management. Here I will be talking about the 3 pillars of decision making. The third one is the meaning. Then eventually we'll go for the meaning of financial management. And then we'll discuss about the aspects of financial management, its scope, objectives, and how we can measure the firm's value and wealth. Okay. Now, for understanding the concept of financial management, we have to take a scenario that suppose we are starting a business. For starting a business, we have to go through 4 stages. That is type of assets to buy, investment, cash from operations, and sources of finance. So in type of assets, we take a decision that what type of assets we require for starting a business, like machinery, premises, and so on. In the very same way, in the next stage, we have to determine what is the total investment required in these assets which we require for starting a business. Then after that, in the third stage, we have to determine what is the daily cash requirement for running a business, which we call working capital. And at the last stage, we have to identify the various sources of finance through which we can finance these assets, which is termed as fixed assets and working, that is the working capital. Okay. Now, so a finance manager has to take 3 decisions in financial management. The first decision is financing decision. In this, a finance manager asks a question to himself or herself that from where to get money. In the second decision, that is the investment decision. Here, a finance manager asks a question that where to invest the raised money. And in the third decision, that is the dividend decision, the finance manager has to identify the quantum of profit which he or she has to distribute among its shareholders to make them satisfied. Okay. Now, so on the basis of this discussion, I'll be giving you the meaning of financial management. So in financial management, what we take strategically, we decide how to acquire, finance, and manage assets for the growth of the firm or business. At the same time, as a finance manager has to align the financial decisions with the business objectives. So there should be a coordination with what the financial decision as well as business objective. And ultimately, a finance manager has to do all these activities, all these decisions with the ultimate goal of maximizing shareholder wealth. Okay. Now, if I talk about the aspects of financial management, so there are 2 aspects of financial management. The first one is procurement of funds, and the second one is utilization of funds. Now I'll be discussing the first part, the first aspect, that is procurement of funds. Now, procurement of funds basically depicts that from various sources we can raise funds for our business, for starting a business, for running a business. So there are various sources of funds, that is the debenture and bonds, owners fund, commercial banks, and angel financing and venture capital. And this list can be more also, okay, depending on the type of funds or sources of funds available in the financial market. Now, whenever we are taking the procurement of funds decision, what we have to take into consideration is that we have to balance cost, risk, and control while financing. Okay. So in this 3 points we have to take into consideration. The first point is what? Different funding sources have different risk, have different cost, and have different control. So whenever you are tapping for any source of funds, you have to take into consideration the risk, cost, and control involved in such source of finance. Then again, while raising funds, you have to ensure that you have to minimize the funding cost. Okay, so you have to raise source of funds at a minimum cost. Okay, which will eventually leads to what? financial efficiency. Okay, so what you have to do in this procurement of funds aspect of financial management? You have to strike a balance. What you have to do? You have to strike a balance between risk and control whenever you are procuring funds or you are raising funds for the business. Now, the second aspect of financial management. The second aspect of financial management talks about what? The effective utilization of funds. So in the first aspect, we have procured funds from various sources. Now we have to invest. We have to utilize those funds in two aspects, that is the fixed assets and the second one is working capital. So if I talk about the fixed assets, what is there? So we have to invest funds in the fixed assets so that we get optimal production, and we have to ensure that there is financial stability. And for investing funds in fixed asset, a finance manager should have a sound knowledge of capital budgeting. So capital budgeting is what? It is a planning process where we decide or we determine how to invest funds in fixed assets, keeping into mind the desired rate of return. Okay. Now, second utilization of funds goes with working capital. So we require funds, we invest funds in working capital. So we have to maintain optimal working capital so that we have enough liquidity or sufficient liquidity. Okay. At the same time, we have to ensure that we don't have excess fund which are tied in inventory, receivable or cash. So for this, for managing this working capital, for effectively utilizing the funds in working capital, a finance manager should have a sound knowledge of working capital management. Okay. Now I'll be discussing the scope of financial management. So where are the scope of financial management? Where we apply financial management? So for this, I have mentioned 4 scope of financial management. Again, it depends on the capacity of the financial manager to increase the scope of financial management. Okay. So the first scope is what? It helps in deciding the size of the enterprise. Okay. It helps in understanding the size of the enterprise, and it helps in marking the growth rate of the enterprise. So by determining the size as well as growth of the enterprise, it helps the financial manager in having sustainable expansion of the business. Okay. Now the second scope of financial management. In the second scope, what a financial management can be used is that it helps in defining the assets composition. Okay. So we can give the classification of asset as the fixed assets. Okay. And the second one is working capital. Working capital. Okay. So with the help of financial management, we can distinguish between fixed assets as well as working capital. So financial management helps in defining the composition of assets with which we can go for, a finance manager go for the optimal resource allocation. The third scope is that financial management helps in determining the capital structure. Capital structure. So what is capital structure? Capital structure is the composition of debt and equity. It is the composition of debt and equity. Okay. So the third scope focuses on deciding the financing mix. So for deciding the capital structure or the financing mix, we use the financial management principles and theories. Okay. And again, in this deciding the financing mix, we have to balance the debt and equity. Okay. Then only value of the firm can be maximized. The last scope is that it helps to analyze, plan and control the financial operations of the business. And by doing this, we can achieve the stability as well as growth of the firm. Okay. So these are the 4 scopes of financial management. Now we'll move to the next slide. That is the objectives of financial management. Okay. Now, The objective of financial management can be classified into, the first objective is profit maximization, and the second one is wealth or value maximization. Profit maximization means what? So whenever we start a business or company, our focus is on maximizing the profit of the business. So financial management also helps in maximizing the profit of the business. Okay, but it is considered as limited objective of financial management. Why? Because there are some flaws, there are some demerits related to this profit maximization objective. The first one is that it is considered as ambiguous definition. So what does this mean? It means that profit term itself is a vague concept, vague term. Why? Because profit has different meanings to different person. So profit can be in the short period, profit can be in the long period. Okay, so it has different interpretation for different person. That's why it is considered as ambiguous concept. The second objective for profit maximization is that it ignores the risk factor. It ignores the risk factors. We know that higher profit will come when we take higher risk. So there is a direct relationship between risk and profit. So if you take high risk, then you will get high profits. So what it interprets? It interprets that a finance manager will always go for risky project. Okay. So if he or she will go for risky project, then what will happen? It will lead to high profit. But is it true? No. Sometimes it can lead to severe loss as well as shutdown of the business. So that's why this becomes the second objection against profit maximization objective. Third is what? Third objection against profit maximization is that it ignores the time value of money. Very important term when we study financial management. So what it means, time value of money? Early and steady returns may be preferable to higher but delayed profits. So a finance manager, a person, a stakeholders always expect what? Early returns instead of delayed returns. That's why profit maximization is objected, because it ignores time value of money. Now, the last objection for profit maximization objective is that it is a too narrow concept. Why? Because it ignores the social responsibilities of the company towards its different stakeholders like employees, investors, shareholders, and suppliers, government, society, etc. Okay. So profit maximization objective leads to ignorance of what? Social responsibilities, ethics, shareholder interest, which risk the long-term sustainability of the company or business. So for running, for the survival, for the growth, you have to take into consideration the CSR, okay? That is the corporate social responsibility. Now, the second objective, this objective is considered as the ideal objective of financial management. Why? Because it focuses on cash flow. So whenever a finance manager is determining the investment in a project, a finance manager should focus on the actual cash flow instead of accounting profits. Second favor point for wealth maximization is that it uses what? Cost benefit analysis. So before taking any financial decision, in wealth maximization, what a finance manager do? A finance manager always do the cost benefit analysis before taking any financial decision. Okay, which eventually leads to what? Optimal return. Okay. Now the third favor point for the wealth maximization objective is that it considers the time value of money, which was ignored by what? Profit maximization objective. So it recognizes the impact of timing on financial gain. Okay. Now, in this slide, we'll measure how to measure a firm's value or wealth. Why? Because I told you in the previous slide that wealth maximization or value maximization is considered as the ideal objective or best objective of financial management. So, for measuring a firm's value, how we measure a firm's value? So, for measuring the firm's value, it is represented by company's stock market price. So, if you want to measure the wealth of a company, you have to look into the market price of company's stock. If the market price of the stock is increasing, wealth is increasing, value of the firm is increasing. Okay, so this is how we measure the value or wealth of a firm. Okay, now the market price of a stock is again dependent on some factors like present and future earning per share. How we calculate earning per share? It is what? Earning after taxes divided by number of shares. Now, second factor is the timing and risk of earnings, and the third factor which affects the stock price is dividend policy of the firm and other financial factors. Okay, so market price of company's stock is very important because it serves as a performance scorecard. It serves as a performance scorecard. So, if the market price of company's stock is increasing, then it reflects to stakeholders that the management of the firm is working efficiently as well as effectively. If the market price of the company's stock is declining, then what it reflects? It reflects that the company's management is inefficient. Okay, and it will eventually leads to losses as well as shutdown of the company. So, thank you. This much for today's session. For other topics, I'll be taking lecture 2. Thank you.